Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special broadcast where we're going to be decoding for you what the RBI Governor has announced by way of Monetary Policy Committee's outcome for the first monetary policy of FY26. 4 to 5 key decisions that have been taken. One, the repo rate as expected has been slashed by 25 basis points. Now the repo rate stands at 6% in nearly 4 years low is what we have actually seen for the repo rate. This is the second consecutive policy when we have seen a 25 basis points cut. The second one of the new governor, Mr. Sanjay Malhotra as well. The two other key points are both on the projections of inflation and growth. We have seen a change. Both have been lowered now. For FY26, the CPI inflation forecast now stands at 4%. For real GDP, it now stands at 6.5%. Both have been lowered for this time from their earlier projections as well. Of course, it was a unanimous decision by the MPC to slash rates. There also has been a change in stance. Again, many economists were expecting a change in stance from neutral to accommodative. That also has happened, and that indicates for more room for further easing of the policy going forward from here. Let's in fact get you an expert voice to really help you understand what does it really mean for you as an average investor, a depositor, a borrower of the Indian economy. From one of our economists who's joining in, Rumki Majumdar, economist at Deloitte India, is now with us on board. Warm welcome to you, Rumki. Good to have you with us. First up, your take on what the RBI governor's announcements have been. Have they come in as per expectations, both on the rate cut front, the stance especially?
Thank you, Sakshi. And yes, absolutely, we were expecting a rate cut because given the global uncertainty that we are seeing, and with the news that came in this morning with the US imposing even higher tariff on China, clearly a lot of headwinds are coming our way. And at this point of time, India needs to make sure that the domestic demand is resilient. And that's where I think the private consumption spending has to be boosted up. We have seen a big tax relief being given, and that itself will probably add to the GDP by 0.6, 0.77%. But the trade threatens about 0.2 to 0.3% of growth. Of course, the RBI expects it to be a little higher at 0.4. But we will have to make sure that India, at least in the domestic demands, remains resilient. So a credit boost is very much needed. And even investors are looking for some key signs from consumers that they are spending higher. So clearly a measure that ensures that growth remains on a strong trajectory, given the fact that even inflation is coming down. So that gives a lot of elbow room for the RBI to take this action. So very much expected, and I think RBI has done a good job of balancing the need for growth and stability.
Okay, on expected lines there. How soon will lending rates start to, get a reflection of the slash on the repo rate front? You expect, Rumki, on the front, because that's the key point for the end consumer borrower at large. How soon will EMIs be lesser? What do you expect there? We had a 25 basis points cut in a February policy as well. Did that get translated at all? And for the new policy after the cumulative 50 basis points, what's your expectation?
Of course, the lending rates will come down now because now banks will have a greater motivation to reduce rates because their margins are well covered. Banks are in a good balance sheet, so their health of the balance sheet is good. And so they have the ability to give loans. And given all the uncertainty that we are seeing, at least it has not impacted the banks yet and may not even do so because RBI has done a very good job of ring fencing the risks that's coming our way. So banks, I think, have a lot of motivation and willingness to cut loans, and we are seeing a lot of it getting translated into consumer loans. Of course, the RBI will keep an eye on how the unsecured loans kind of move because that is something which kind of impacts the stability on the financial sector. But as the government rightly pointed out, the financial sector is very stable, so a certain risks can be taken at this point of time.
Okay, but do you also believe there could be some tinkering on the deposit rates as well once we do see an impact of the cumulative 50 basis points getting translated into rate cuts on the lending front? Will deposit rates also be at a risk of, seeing some cuts, and therefore should the FD and RD depositors in India, should they again relook at their strategies of their deposits?
So this has been a challenge for a very long time. If you look at credit deposit ratio, this has always been a problem because
Yeah.
of lower interest rates for a very long time. The banks are not able to attract and much of savings into the fixed deposits. Plus now the secondary market, the stock market has been giving a lot of returns. So that actually entices a lot of young consumers or young investors into the sector. In fact, 40% of the young of people aged 30 years are there in the stock market. So clearly, there is a lot of diversion of savings happening into the secondary market. That makes it even more challenging with if the interest rates comes down, because now banks have to now really have a uh, lot of ways, innovative ways it has to think of to attract FD. But there's one point that I would like to highlight, that given the stock market volatility that we have seen over the last few months, there might be some tendency to remain a little more cautious, little more safe bet, to make more safer bet. And Indian by culturally they are all risk averse that way. So probably they might think of FD as a better option right now, given the stock market volatility that we have seen over the few quarters.
Okay. Now, help us understand what's your overview. We have seen twice the rate cuts happen. What goes on in future? Do you see or expect continued decline going forward? I mean, out of the six policy meetings, one is already out. We have five more meetings to go for this fiscal year. What's your anticipation, and also of the end repo rate that you expect from this new cycle?
There could be rate cuts, provided the inflation keeps coming down, or is at the pace at which the RBI has predicted.
Yeah.
That will give some room to cut policy rates. But there are a couple of risks that India will have to take care of. One, we might be seeing a higher inflation in the West because of what
Yeah.
is happening. Their import bills might go up, inflation will go up, and we will be importing that risk into India. Of course, oil prices will remain low in global uncertainty, so that will probably offset a bit. But of course, inflation in the US will have an impact on us. And again, if US inflation goes up, the Fed might not go for rate cuts, as many rate cuts as was anticipated. So for us, if we reduce our rate cuts and the Fed doesn't, then our interest differential reduces, which means our ability to attract foreign capital also reduces.
Correct.
So we have to ensure that this differential it remains so as to be attractive as an investment destination. A lot of opportunities are actually kind of coming up, because as we see, India stands to gain in certain sectors, and we will likely see a lot of activities there. So we are hoping we will probably easily say sail through, and we will see a lot of growth coming into the economy. So
Okay.
RBI will probably be able to ensure that accommodative stance continues.
So, how many rate cuts are you penciling in, and what will be, say, by FY26 end? Where do you think we will be at?
Another couple maybe.
Okay.
Beyond that, it probably doesn't make sense, because then the differential will come down very much lower than.
Okay.
So we
So,
expect
about
another,
50 basis points
yes,
or more?
another 50 basis points maximum, yes.
Another 50
But
basis points
again,
of
if
five and a
yeah,
half.
yeah, but if inflation goes up, if we see inflation going up again, and that's why I think RBI did a good move of reducing rate cuts now, because in case risks again increases, then RBI can actually maneuver better.
Absolutely. Now, you did talk about these external factors. Everything hinges on, and even the governor did point out that they are on alert. They're looking at the external factors, what's happening with the tariffs, and what is the likely impact on the world economy at large. We have seen the revision on the GDP forecast now at 6.5%. But looking at the uncertainties that we are grappling with, do you still believe that this is more on the ambitious side, and there could be further more tinkering going forward on the growth forecast as well?
In fact, we are quite optimistic, because I feel what India will be able to do is make a lemonade out of a lime, because
Okay.
a lot of opportunities coming up, especially if you see the way tariff has been imposed. A lot of industries in pharma, in electronics, in textile, got quite a few opportunities coming up. If
Hmm.
India is able to manage to come up with the BTA by the fall, then I think the US administration might go easier on tariffs with India. So that again brings back some opportunities. Uh, as I said, there is a tax exemption that is going to give a big stimulus. So the lot of positives can work in, but of course, a lot hinges on how global uncertainty, how widely it can vary. If suppose there are more escalations to the situation, global economy will slow down and hence it will impact trade. So, but there are opportunities which can actually, there are basically both positive and negative sides coming up, and I think we feel that there could be quite a few positive opportunities India can benefit on.
Okay, India could benefit, and there are a lot of opportunities that we can make use of. How about your inflation forecast and your own GDP forecast for FY26? What is that at?
So we are expecting around 6.5 to 6.7% growth.
Okay.
And as I said, as I said, we are probably being cautious. If things go better for us, it could be even higher. And we are betting big on the tax exemption that came earlier this year.
Okay.
Inflation, we expect it to be lower. If monsoon is average or is above normal,
Yeah.
then food inflation will surely come down. We have already seen that happening, and
Hmm.
core prices are very much anchored. The only risk remains is where how the U.S. inflation moves and whether we are importing that inflation into the country. If that is checked, then I think inflation will also be around 4.2, around 4 to 4.2 is what we are expecting, which even today RBI reduced the inflation rates as well. So we are also in line with the belief that inflation will remain uh, much more within the range of RBI's target rate.
Okay. What's the big takeaway for the bond market from today's, announcements that have been made by the governor? What do you expect here?
So I think we are seeing bond yields improving, and I think there is a lot of confidence in Indian economy. In fact, this morning, there was a news that one of the biggest phone makers is now planning to produce more from India.
Yeah.
Clearly this shift will happen even more. So if that happens, clearly in India is being seen as an investment destination, and with the tariff we are seeing India is probably better positioned compared to our competitors like Vietnam,
Hmm.
Bangladesh, in this segment. So clearly this will start reflecting in yields, and yields will come down because we will see a lot of credit growth happening, a lot of investments happening. So it will be range bound, and uh, I'm very optimistic about how things would pan out from here on.
Okay. Another aspect that I wanted to discuss, Rumki, with you is the currency. So far we are seeing some kind of a depreciation as well on the rupee too. Vis-a-vis the world, we are also seeing some concerns and expectations that some devaluation of currencies can also take place in some Asian countries as well. What do you think should be the stance that we adopt on rupee at this point?
So I think rupee, RBI is keeping a close eye on how rupee moves. And if you look at the pattern in which the rupee has depreciation, it has always been a step function.
Yeah.
It depreciated, remained stable, again depreciated, and all these depreciation happens at a time when the dollar appreciates at a very fast rate. And this is something which we have observed over the last 5 years.
Yeah.
Now we are seeing, in fact, dollar appreciated. It touched around
Yes.
87. Now we're back to 85. So clearly the RBI is keeping an eye. It will not let it appreciate much, but it will not let it depreciate as well. Now, question is, if we have to cushion the impact of the tariff coming our way, we probably have to ensure that currency doesn't appreciate much, because it will make it even harder for the exporters to compete. So it will probably keep it range bound. And if the US economy sees trouble going forward, then dollar index might not also be going much up. So that will also help RBI to keep the volatility intact.
Okay, fair point. You know, I also wanted to just speak about some of the other measures that were announced, the non-policy measures that were announced in the comments. One was on the gold loans. The RBI is really looking at issuing a comprehensive guideline. We have seen what the RBI has earlier indicated on and measures have been taken against the gold loan companies too. So now finally the policies, do you expect them to be tighter? What do you think will take place now?
So it's a very delicate balancing act because the reason why they were tightening it is they didn't want the consumers to get over leveraged.
Yeah.
Because when your interest rates were high, consumers were not able to tap into the formal borrowing through banks, and they were probably using gold loans. But that doesn't help, because at the end of the day, consumers are our backbone, and if we get them leveraged, they will not be able to face any crisis. So there was a reason why they were being careful. Now again, given that the gold prices are high, it kind of gives some relief for consumers because they can borrow. But and I think with the stance becoming a much more easier right now, I think that's why RBI is kind of looking at how to boost credit growth, right? Because it has to make a choice of what it needs to do right now to boost growth. Because once growth, it's a kind of a virtuous circle. Because once
Yeah.
credit growth improves, activity improves, it will result in more job creation, more opportunities, and consumers can actually ensure that the balance sheet is checked. But we have to ensure that virtuous cycle kicks in and continues.
All right. Okay. Rumki, it's always a pleasure to host you and listen to those wonderful insights that you always have to share with our viewers and explain very, very simply as to what is expected going forward from here. Two, three key takeaways that Rumki has really marked on the show. One is that she's optimistic on India and India's growth projections going forward, 6.5 to 7%. India is also on a better footing vis-a-vis the other countries at this point in time. Looking at what's happening in the changing tariff world order, India could stand to benefit and make greater opportunities of use at this point in time. On inflation, inflation could inch down and be within the comfort level of the RBI band is what Rumki has marked. And of course, another 50 basis points of a cut is what we can expect as far as the RBI policy is concerned going forward. So about 5.5% of repo is what we are given to understand. Thank you so much, Rumki. Always a pleasure to seek all these wonderful insights from you. With that, viewers, we wrap up this special conversation, but do stay tuned onto Business Today Television. Up next will be Daily Calls that answers all your stock-related queries, on RBI Policy Day and amidst the tariffs getting imposed on 180 countries starting today. Apart from this, you can continue to stay tuned. There will be a whole lot of conversation around the RBI policy and all the measures that have been announced regarding gold loans and other non-policy measures as well. And of course, what it really means for you as fixed deposit investors or borrowers at large. So stay tuned. There's a lot more, an action-packed day ahead for you.